Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1M, as you know, is the first and only global virtual accelerator for technology startups in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And notice I said $1 million in annual revenue. I did not say we're trying to get 1 million companies funded. That is not viable. In fact, we categorically support companies that are not fundable and have to build as bootstrap ventures as well. So we have a real reputation around the world for being very, very supportive of bootstrap ventures. And in fact, we have companies that are bootstrapping with a paycheck, bootstrapping with services, and all kinds of creative bootstrapping mechanisms. And we follow very strictly the principle of bootstrap first, raise money later. So companies who come into the program start by validating before going out to raise money. This is the 538th 1M1M roundtable. We've been around since, well, we've been doing these experiments, these online mentoring experiments since the fall of 2008. And the experiment was successful. That led us to founding 1M1M in 2010, the beginning of 2010. So now it's been a very long time, over a decade, that we've been doing 1 million by 1 million. And it's a pretty well-distributed program. This event is being recorded. Every single roundtable of 1M1M roundtables are on our YouTube channel. You can go check them out if you have time to listen. On Twitter, we're at 1M1M and at Stromana. If you're live tweeting today, please use hashtag 1M1M. These are the call-in instructions. You can also activate your computer audio to call in. This is a roundtable, not a broadcast. So we want you to participate as much as you'd like to throughout the session. We do have scheduled programming first. So listen to that. During that, participate through the public chat, but afterwards I will open the line up for you to call in and talk. We are going to start today's session with a conversation with Ben Narasin, founder and general partner of Tenacity Venture Capital. Ben, welcome to the show.
Thank you for having me.
So let's start by having you introduce yourself a little bit to our audience, both to your personal background as well as the genesis of Tenacity. I know you have a new fund that you want to introduce.
Yeah, thank you. So I am, my background is a mix of, I spent 25 years as an entrepreneur. That culminated in starting one of the first e-commerce companies in 1993, when people didn't really know what the web was. They didn't even know what the internet was. And then in 99, I was able to take that company public, a company which I basically bootstrapped. So since I did not raise any venture capital and I bootstrapped it, I still had control of that business when the bubble burst. And I was able to take it private, which allowed all the shareholders to participate equally and fairly in the relatively significant amount of capital we'd accumulated at the time. That was in New York City. I left there, moved west, ended up in California about 18 years ago. In Silicon Valley specifically, and became very enamored of the entrepreneurial community here and became a seed investor in 2007. I was recruited in to build and run the equity practice of a large venture debt shop. And in 2007, I believe there were three of us, three different organizations. I think Josh Koppelman had started First Round Capital about a week before I came on the scene. And I think Jeff Clavier was active in the business. I think that was it. Those were the three institutional seed funds. Now, since then, seed has grown quite a bit. So I spent about 8 years as a seed investor, and then I had two $5 billion outcomes in a year, and a lot of my friends I'd gotten to know in venture started talking to me about crossing over to become a traditional VC. So I spent the last 6 years as a traditional VC, most recently at NEA, New Enterprise Associates, one of the largest and oldest venture firms in the world, a really phenomenal group of people. And I just recently, actually only about a month ago, spun out to raise a new freestanding seed fund called Tenacity Venture Capital. So now it's a blend of my 25 years as an entrepreneur and my 14 years as an investor. I'm now a entrepreneurial investor, a founding venture capitalist. So I'm out raising money just like all the entrepreneurs I've ever talked to. It's gone well. I'll tell you some of the specifics if you'd like about the fund, but while I was told it would take about a year, which was fully what I expected, I was able to raise the first half of the fund in 25 days. So I think having a 14-year track record with a lot of high-performing funds has made it a lot easier versus just having a theory of things that I might want to invest in. And I'm all about, the founder, the opportunity. I always say I need 5 things to make an investment. People, a great idea, and a huge market if it works. I want to fund phenomenal founders who already have ideas I love and who have the opportunity to build truly unbounded and enormous upside businesses. So that's a capsule.
So what size fund are you building with Tenacity?
Yeah, it'll be a $50 to $60 million fund. Because I'm a sole GP, so in essence, it'll be a one-man band. And I look at my history, and I look at about 1,400 to 2,000 pitches a year, but I only fund about 7 to 10 when I'm doing seed. And since this fund will be leading and co-leading, I assume it'll be 7. So basically, the way I figured out what size fund would be appropriate is I looked at my pace, which I don't want to change, because I think when people try to change their pace, they lower their bar, and that results in less compelling returns. So if I do 7 deals a year, according to PitchBook, the average seed deal was $2.6 million in the first quarter of this year. So that's an overly simplistic rubric. I said 7 times 2.6 times the 3 years it'll take to deploy gets me to about 55 million, hence the 50 to 60 million range. Right now, if things continue at the pace they have, it looks like I'll have more capital available to me than I'm asking for. But it is important to me to maintain the rigor of keeping it in that size, because as I mentioned, I think that when people raise more money than they plan, it changes their behavior, and I don't think it changes it in a positive way. So I want to keep it tight.
Yeah, well, I think in the 90s, the venture funds that worked in the early stages used to be about 250, 300 million. And then they started changing size and started becoming billion to billion funds, and they lost the capacity to do earlier stage investments in many ways.
Yeah, you're absolutely right. In fact, this was part of the phenomenon I saw, in 2007, was that there was this gap in the market because you had a variety of angel groups and angel investors, and they were very small checks and very slow processes. And then on the flip side, all these venture funds that used to be a few $100 million had turned into multi-billion dollar funds. And so they had to write bigger and bigger checks because it's very hard to scale venture capital. I'm not sure you even can. It's a people business. It's still a cottage industry. There's lots of reasons. I'm happy to talk about it if you'd like. But what happened was when you had the small and slow over here with the angels, and you had the bigger checks in the venture, in the middle was what is now called seed, but there was nobody doing it. And so that's why it seemed like such a great opportunity. Just creating a model where, on the back of the fact that the web had empowered people to start businesses so quickly and so inexpensively, they needed a source of capital that could match that relative ease and speed compared to the prior era. And that, it's obviously been a successful category and grown quite a bit since the 3 of us were out there.
Yeah, in fact, today the industry is kind of fragmented or segmented, I would say, in the seed and the capital industry into pre-seed, seed, post-seed, pre-series A, post, like early series A, like a small series A, and then traditional
baby A's and mango seeds.
So yeah, where are you positioning? What's your
I'm happy with anything before the Series A. Incubation, formation, pre-seed, seed, second seed. Pretty rare on the second seed, to be honest. But it's just my focus has always been finding entrepreneurs that I believe to be venture scalable and helping them raise their first venture round. And I've had a very high conversion rate, so it appears that's worked. I got to know over 327 VCs in my 8 years as a seed investor. And in that 8-year period, between 63 and 71% of the companies I seeded went on to raise follow-on rounds. typically Series A's from tier one firms. And those rounds often came either from introductions I made, or I was involved in, I funded 80 companies in 8 years, and I believe I was involved in every single Series A. Now, that doesn't mean the entrepreneurs always took money from the people I introduced them to, but I always introduced them to, one of the things about the venture debt industry is they tend to be very well aligned with the top tier firms. And so, my 327 person network was entirely derived from sort of the top 15 firms. So a lot of my work was figuring out who to take entrepreneurs to that would be right for their business and their personality. And so, I like to get there early enough to be helpful, sometimes to be even a little bit formative to the business and the entrepreneur's development, and then to help them pick the right partner and to help them with that fundraise. So, anything before the A is fine. I've even sometimes been brought in on the A. I had an entrepreneur, great founder out of LA, and I had seen her in a startup competition and we talked a lot, but there was a risk I couldn't get comfortable with, so I decided to wait. And she came back to me 6 months later for some advice and talked about how she was doing, and she was doing exceptionally. And I was like, I think I probably should have invested. Can I invest now? She said, well, it's too late, it's 6 months later, but if you can help me raise my Series A, then you could invest alongside. So I introduced her to the fund that became her Series A investor and participated in the round. So, a big part of my thesis and value add, and the thing a lot of my entrepreneurs will say, is that I can really help them get a successful Series A done. If they're like, one of my little rules is I'll help you raise your Series A if I think you're ready, not if you think you're ready, because it's one of those things a lot of people want to do, but it doesn't mean they're ready for it. And, I'm very picky about who I introduce to who. And that's true for both. I want the entrepreneurs to know the right people. I want them to have the right possible board member, but I also want to make sure the VCs are seeing companies that are fundable. In making introductions to VCs over an 8-year period, and there were hundreds, I think I had 2 people ever say no to an introduction. Interestingly, I think Mark Perry was one of them. I guess I didn't know him as well as I thought, but that was it. 2 people said no to companies that got funded that they should have said yes to at least meeting. So, it's been a good track record. I'm happy, and I think my entrepreneurs are very happy.
I'm smiling because we do exactly the same thing. Very often people come to 1Mby1M looking for investors. We don't operate as a fund, but we have a network of hundreds of investors who work with us and look at our deals, and we are very particular about making sure that they're fundable before sending them to VCs by our judgment, not by their judgment. And it's exactly the same logic that you just laid out that we have in how we do the investor introductions.
Yeah, it's very important because, it takes a lot. I spent an inordinate amount of time and money over that 8-year period getting to know these folks. I was very fortunate to have a platform that gave me pretty much unlimited time and money to do it. But, those relationships are, I think of myself almost as, this is not a perfect analogy, but over the last 18 months, we've been fostering puppies. And we have fostered 64 puppies. My attitude is my job is to give these puppies a safe, happy home. So when they go off into the world, they are good puppies to the families that are their forever home. And so when I think about my own interactions with my entrepreneurs, like I have a lot of adopted, let's call it children for lack of a better term, and I can't bend the discipline, because if I do, then that really deserving, phenomenal, let's go with puppy, doesn't get the opportunity if I sort of stretch a bit to get someone that's not ready to go out there Yeah. And so, you want to protect those relationships. Those relationships, this is a very, life is long normally, and you want to make sure that both sides, it's one of the peculiarities of the venture business, by the way. I remember I was talking to a VC once. We were on a board together or invested in the same company, and they were raising a Series B or a Series C, and I was making all the introductions. And I said to the VC, like, why am I doing it? I'm a seed investor. You're their VC. Like, shouldn't you be making these connections? And they said, Ben, I don't usually make connections to my entrepreneurs. If I connect an entrepreneur to another VC, it makes them look weak. Now, I'm not going to say everybody feels that way, but I have found it's relatively common.
It's a very odd logic. I don't agree with that at all.
I think that a lot of VCs feel like if it had to be introduced, it wasn't strong enough to get there on its own. But when you've got a seed investor, it's the opposite. The seed investor is expected to make those introductions. And every venture firm, and I've worked in a couple, they always have a list of the seed investors that they want to stay on top of and that they respect. And so as long as that respect is maintained and that trust, they're going to listen to what is said. So, when I help entrepreneurs raise, the number one thing that'll happen is, I make an introduction, they go in to have a pitch, and if the VC likes it, I get a call, and it's like, tell me about Bob, tell me about Jane. They want to know what my year with that entrepreneur has taught me. And, they all have, basically, when they say, tell me about Bob or tell me about Jane, what they're really asking is this, and sometimes they just ask it this way, is this the long-term CEO? Is this the entrepreneur that can take it all the way from the exciting growth they have today to a future public company? And, and by the way, if they're not, is it going to be a problem? So, by then I'll be able to say, I don't know if they can scale all the way to IPO, but I'm positively inclined to believe so, because usually those are the type of people I'm taking out. And I think they're so dedicated to this business that if they were not the right person, they would probably see the logic of perhaps becoming the, if they're highly technical, maybe they become the CTO and bring in a professional CEO or whatever it is. But, it is interesting to me that when I was a VC, all the people I know tend to call me when I introduce them to entrepreneurs if they're interested. They're either asking about the entrepreneur or they're asking how to win in a highly competitive round because they want some back channel. They want to understand what they need to do, what they need to offer to get this round to come together. But having been on the inside of multiple venture firms, it is very rare for VCs to reach out to the earlier investors, which I find confusing because as long as there's a trusted relationship, they're a great source of intel. I mean, what better way to know a little bit about an entrepreneur than to talk to the person that spent the last year with them and watched how they developed? So it's a funky world. It's a small world.
It's a very funky world.
Yeah.
It's a very funky world. I've been in Silicon Valley since 1996, actually. And it has changed a lot, but yes, it is a very funky world. So let me ask you, one of the points that we stress in 1Mby1M is just like you're looking for product market fit, you also need to look for investor entrepreneur fit to make a deal happen.
Yeah, absolutely.
So what is your investment thesis? People, great market, all of that is kind of generic, but tell me a bit more about what you like to invest in, what kind of things, what problems in the world that you have your eye on perhaps, and what segments do you particularly like? We talked about you starting off as an e-commerce entrepreneur. Is e-commerce still an interest, or is that a played out sector for you?
It's funny. I remember once I met I made a very proactive effort to meet every VC at the top 15 firms. I mean, I tried to cover 100% of them. And there was let's just say an investor had just joined one of the best firms in the world. And I took him out to lunch. And he told me a story of what he had done. He had basically created let's go with mobile advertising platform, which sold for maybe a little shy of $1 billion. And he still owned most of it. So he did exceptionally well. And I said, oh, that's great. I have 2 really great mobile ad companies you should meet. And he was like, Ben. You've got to have a lot of naivete to invest in mobile advertising. And I was like, oh, interesting, since you made, $500 million personally doing that. But the reality is, I would argue everybody that's ever done something thinks anybody else that does it must be naive because they know how hard it is, right? You have firsthand experience of how excruciatingly difficult it was to do that thing. So there's no illusions about it. Now, interestingly, of those 2 companies, one sold for about $1 billion and I made 60 times my money. And I think the other one didn't work out. So, it worked out for me on a blended basis. The reality is I've looked at e-commerce. I just haven't found it. I probably have a higher bar there because of my experience, just like there's some other categories. I am a generalist. I believe the best entrepreneurs are highly focused, but I believe the best investors are generalists. Think about it. Sequoia and Benchmark, which are the 2 best firms in the world, return-wise, are both generalists, and every investor there is a generalist. Scott Sindell, who runs NEA, he's a generalist, one of the best investors in the world, certainly of our generation. The best investors are generalists. I am more focused on...
I'll push back on that. Hang on 1 second. There's a company that I have great respect for, that is Emergence Capital. That is not a generalist firm at all. They started with in fact, I was I did their story just like you were talking about your starting Tenacity. And at this point, is a similar point. I had talked to Brian Jacobs, and he presented a thesis of investing in SaaS at a time when nobody was doing SaaS, and they did phenomenally well with the whole SaaS trend.
So I'm not saying only generalists are great investors, but the very best investors are generalists. I think Ribbit is an exceptional firm, and they do fintech. They're great fintech investors. I do a lot of fintech. But the way I think about it is I'm hyper focused on the entrepreneur. The firm is called Tenacity for a reason. I think that brilliance is assumed, or I wouldn't have funded you. A great idea is assumed, or I wouldn't have funded you. And a huge opportunity is assumed, or I wouldn't have funded you. The only secret to your entrepreneurial success is tenacity. I spent 3 years, funded 30 companies, and had 0 fails. And this worried me a great deal because I thought I wasn't taking enough risk. And so I loosened up. That was a mistake. I had my very first fail, and it was an entrepreneur who gave up. He gave up with money left. It's like the horrible story I heard when I was young from my parents who were scuba divers of a man that was found dead in a cave doing a dive with a full tank of oxygen. Giving up is not an option. Like work-life balance, also not an option. Those are not things that work for people that want to be entrepreneurs. I mean, they can be entrepreneurs and just sort of
again, I disagree with you. They don't work in venture entrepreneurship.
Oh, yeah, sure. I mean, in fairness, I'm only calibrating for that. Look, I think that should be clear from the beginning. I'm focused on people that want to build future companies.
The pushback is my audience is not just if you say that you're not an entrepreneur, if you cannot have work-life balance, I have to push back on that because I have a very different segment as well that listen to these.
That's fair. But we're talking about like what I solve for and what I look for, and I look for venture scale entrepreneurs, and in that category, if you believe you can have work-life balance, I would like to meet the examples of the people that do, because I never have.
No, actually, on the contrary, I think venture scale entrepreneurs very often end up with 3 divorces in their lives. So yes, you're absolutely right. Work-life balance is most likely not an option.
Yeah, and it's not like I'm saying you need to ruin your life to be an entrepreneur. It's more that having lived through the realities, if you are going to pursue this type of entrepreneurship, you need to go in eyes wide open. Like my grandfather was an entrepreneur his whole life, and he had work-life balance. He had a solar business when the laws were such that he could have solar. He had a chemicals business. He used to own laundromats. He came home and he had his life, and he did well. But there's a huge difference between being a sort of, for lack of a better term, day-to-day entrepreneur and being a future public company CEO. A hot dog stand is an entrepreneurial endeavor. When I was in college, I had a Dove bar truck.
So it's also an entrepreneurial endeavor. It's a $1 billion bootstrap venture. And if you ask that CEO, that's also a very different story. So the reason I'm pushing back on a lot of things that you're saying is that they're a bit insulting to another category of entrepreneurs whom we have made a very strong effort to nurture. And we continue to believe that the venture way is not the only way. It is your way.
I totally agree with you. Yeah. In fact, I'd say the number one piece of advice.
Don't the insults, please.
Yeah, no, the number one piece of advice I give entrepreneurs is usually, avoid venture capital, because there are a lot of businesses that can be really good, really healthy, wealth creation businesses that should not have venture capital because it creates a disalignment. Like everything you're hearing from me is not what I believe every entrepreneur should do. It's just the type of entrepreneur.
And the most important thing is that big market opportunity. Hyper growth is not a natural state of business, a very rare state of business. So
absolutely, if
every entrepreneur thinks that we have to achieve hyper growth, that is not viable. Most businesses don't have the characteristics of being able to meet that hyper growth criteria. So
absolutely agree. I mean, that's why I look at close to 2,000 companies a year and I only fund 7. It's not the 1% of entrepreneurs that make sense for this. It's sort of 10 basis points. And I think sometimes there's a lot of unhappiness created or just wasted time when somebody that has a really good business So venture wasn't built to fund really good businesses. It wasn't built to fund even, great businesses. It was built to fund phenomenal outlier
I
businesses.
figured that's right, exactly. But I think the problem that has been created in the media is that, the media has kind of positioned entrepreneurship equals venture capital, and that is what has created all this
Yeah, yeah,
misconception and anxiety
yeah.
and rejection, constant rejections. I mean, if you get a lot of rejections, it's bound to discourage you, right? So if you're going out there too early, you're going out there without the right goods, and you're not a fundable entrepreneur, you go out there, get rejected and get rejected and get rejected, and you don't understand why you're getting rejected. That's really a recipe for disaster.
Well, that's why I'm so, I don't know, for lack of a better term, transparent about this point, because I think it's a great disservice for an entrepreneur that should not raise venture capital to spend time trying to do so. It's a waste of their time.
Yeah.
There's nothing wrong with a business that doubles every year and that makes you a healthy living. But, like lions only eat meat. So don't try to feed a lion a salad or they'll eat you instead. So, like using up your time to go out there and try to raise venture capital when you've got a nice, like you said, hyper growth companies are rare. But that's sort of what venture seeks out, and finding that match is really important. I see a lot of people, I don't know if it's the media as much as it's just that there's this, well, in Silicon Valley, it's almost like if anybody lives here, they assume their business should raise venture capital, and that's, not the case in the vast majority of instances. And you just, you need to, there's lots of different forms of capital, and I think it's it's a long-term marriage. When you go out to raise money, you need to be able to find the kind of capital that matches the realities you want to build. Because if you don't, you end up in a situation where you could be in a, ultimately, if you were, let's pretend for a second that you had a business you wanted to build as a nice lifestyle business, and yet you managed to raise venture capital. Well, you sign a one-way prenup and you don't get the right to exercise it. So it tends to go poorly. I never raised venture capital. I had a business that I guess, it was hyper growth, but it wasn't at the level. Even though I got that company public, it was not a venture fundable business. And had it been venture funded, I would not have
In
survived.
fact, in fact, your e-commerce category right now, I think, is full of companies that are not necessarily venture fundable. They're niche e-commerce businesses. There's still lots of niche e-commerce businesses starting left, right, and center. Shopify is very easy to get a company started with. And then there are other kinds of financing available. You can, get inventory financing. You can get on deck to finance your transactions. Exactly. There's Cabbage and on deck, all these fintech firms that will give you a little bit of money to keep, moving forward. So, I mean, I was curious to hear your analysis of e-commerce, because e-commerce is starting to get to a point where most of it is not really venture fundable at this point.
Well, it's interesting. There's within the category, there's some venture opportunities, certainly. As an example, today, 54% of all merchandise sold on Amazon is sold by marketplace sellers, not by Amazon. So like as an example, I wanted to understand that better. So I have a little side business. It's not even really a side business. It's just I bought a pallet of Amazon returns and then relisted it on Amazon and on eBay to sort of see what that was like. Now, the reality is the most compelling marketplace sellers are selling their own unique product. But that business, that 54% of volume is made up of everybody from the sort of sole operator selling a single product to multifaceted players. What has started to happen, though, is on top of that, now that people have figured that dynamic out, there have become a handful of venture-backed businesses which are buying those individual sellers and stitching them together in an effort to become the quote-unquote Procter and Gamble of
roll-up.
So they're doing exactly. They're doing a roll-up. They're buying companies that are, call it, maybe it's even as little as 1 to 5 million in revenue, but they're adding it all together to create a bigger quote unquote venture scale opportunity. So not only is there financing available for these smaller businesses through the people like, I believe it's Clearbank, that will loan against your advertising. If you can show that by spending $1, you can make $1.80, then they will fund that. And I actually invested in Cabbage when it first started out. They would fund sellers on eBay against their selling history. And now, so one, you have a source of capital, as you pointed out, but two, you have a source of liquidity as an exit. So you build your business up to a $5 million revenue business, which seems like a healthy lifestyle business to me. If you're making 40% gross margins, that means $2 million of that's flowing to you. And if you can keep your operational expenses low, that can be a really great living. But then later, there are people that will buy you because they want to roll you up, and they're paying nice multiples. It's very rare for businesses that small to be able to be paid, revenue multiples, but it's happening. So there's a great opportunity for an entrepreneur, with your million by million model to get to that first million in revenue as an Amazon seller. I maybe get it the next time, spend another year or two to get to 2 or 3 or 4 or 5. And by the way, there's not just one buyer, there's multiple buyers, which drives the price up. So a lot of opportunity both for cash flow and for ultimate liquidity. And I learned this. I didn't have $1 billion outcome. I was not an entrepreneur. I was the type of entrepreneur I would want to fund, but I didn't have the opportunity of the scale that I wanted to fund. And I'm very happy. It's funny. We all have a quest to understand what life means to us. Every once in a while, I'm somewhat philosophical, and I'll have my entrepreneurs come over to my house every once in a while. My attitude is, if you need me, I'm there for you. We just have to figure out how to make the time work. And I do want to respect the time with my family, and I've always kept the weekend sacred. That was sort of my golden rule. That was as close to work-life balance as I could get. My wife and I, when we were about to have our first child, we talked about it quite a bit because I was working in a company that would go public a couple years later. And she said, "Look, if you can work all-nighters 5 days a week, just give us the weekends." And I thought, yeah, let's do that. And I carved out, a couple of weekends for our trade shows. And during our IPO period, I worked every single day except one Sunday. But that was always my model. So now, with my kids a little older, I say, I'm happy to be available to you. But if it needs to be right away and it's Friday, I need you to come to me. So they'll come to the house in the evening, or they'll come to the house on the weekend, or sometimes we'll meet at the airport if I'm flying in or they're flying out or whatever. I'm pretty flexible on finding time for my entrepreneurs, however it works. Time is definitely not my friend. It's just anyway, at one of these sessions, we were talking for, it was like an hour in, and the entrepreneur had all these questions. And I looked at him at the end and I said, you're not really asking me about your business. You're questing for the meaning of life. And it reminded me of me in my youth. And I traveled around the world. I literally bought round the world tickets. I was just trying to find the answer. And my view is the meaning of life is different for everybody in some ways, but you won't find it, it will find you. And this whole long ramble comes down to this. For me, when I finally found my meaning of life, it's that happiness is not about having what you want. It's about wanting what you have. And when you have satisfaction in what you've achieved at whatever level that is, that's happiness, right? The problem, and in fairness, sort of going back to my push on where things needed to go for people to be a venture scale entrepreneur, is when your desire can never be quenched because it so far outreaches, like when it's never good enough. That creates an enormous amount of unhappiness. And so, I think it is human nature to always want more. It's the natural sort of greed is good thing from the Wall Street movie of greed for life, greed for success, greed for, and ultimately when what you're building makes you happy because it is at the right sort of, equilibrium, then that's awesome. And that can be true at any level, right? Now there's this whole movement amongst younger people, the FIRE thing, of being fiscally responsible and retiring early. I'll tell you, by the way, I retired early and it wasn't something I need to do again. It wasn't something I enjoyed. It's quite boring. But, like fiscal responsibility so that you can have flexibility is a great thing. I mean, having flexibility, and look, bluntly, I mentioned I had a Dove Bar truck, right, in college, and I would drive around and sell my Dove Bars, and I had fiscal freedom because of it. Because on a weekend, I might sell a couple $1,000s worth of ice cream bars and have a, $1,000 in my pocket as a college student. Hey, in a weekend, that was great. That was a lot of freedom. I was very happy with that. I didn't need to take that.
One of the things that we have tried to do in 1Mby1M is pose that question of what is success, and exactly your point. We have come to the same conclusion that success is personal. You have to define your success. At what level do you feel whole and you feel like you're good? You're at peace with yourself, and define that and execute to that instead of trying to live somebody else's life. Yes, there's a category of people who want to build these billion-dollar businesses, but there are trade-offs in that. And if that's the direction you want to go, great, but know what is involved in that. Don't stumble into that. That's a path. That's, you know. All right, let's listen to some entrepreneurs. Folks, just before we get going, just want to set some expectations. This is a safe working session. You don't need to be defensive. This is not Shark Tank. We are not going to try to make you feel bad or anything. It's just a constructive way to look at your business, analyze your business, and see what are your strategic options. You can disagree, no problem. You can do what you want. It's your venture, ultimately. But as we have spent quite a bit of time talking about, is not all businesses can raise money and not all businesses should raise money. So don't blindly chase venture capital funding. Davide Balbi from Cassino, Italy is our first presenter. Davide, over to you.
Thank you. Good morning to everybody, or have a good day for everybody. And Ben, thank you for sharing your experience with us. I really listened. I enjoyed listening to you. And hello to everybody. My name is Davide Balbi, and I'm a result-driven person. And I study and practice neuro-linguistic programming since 30 years. And I really like to have fun while I work. And what I'm doing today is something that keeps me closer to my family and has been a result of the experience of my life. This is very important for me. I changed a lot. I didn't born as an entrepreneur, I didn't run company. I was working for multinational company. I worked for a Fortune Nasdaq 500 fast growing. And then at a certain point of my life, I decided that I wanted to do more. I wanted to decide my life. I wanted to change the world. And this is something that I really enjoyed when the photovoltaic business came out. And at the beginning, when I saw that I could do a green business and business together, and work, I was like amazed. So that's why I changed my life, and I moved out of the big city, and I started working on this project. This project born in 2014. It's called Agricultura 2.0. We had a major call from the Milano municipality and the PTP Science Park that asked for a project that could give to the market food sovereignty, food safety, short chain, and low carbon footprint. So I wrote, I was, when I read the call, I was telling myself, I have it. So I wrote the call, and I won. I have been incubated in the PTP Science Park in Lodi, in the Lombardy region, close to Milano. And since then, I start creating what could be something that could make the difference in Italy and through the world. So,
Davide, what is the business? We have a limited amount of time, so let's focus on specifically your business. What is it? What problem are you solving? How do you go to market? And what is your strategy?
Okay. So we started analyzing the markets. Today, the farmer is a price taker. And when we purchase food, we can say that we eat and we purchase poison food. So the challenge is to be able to give a win-win solution to the farmer and to the customer meanwhile. So today we are able to produce healthy vegetables. We have a patent deposit for higher nutrients inside. And the solution we are working on, it's a solution that give the chance of sustainability to ourselves, to the farmers, economically and to nature. So these are the four pillars we are working on.
So what is it? You have a farm? What is the business? Is it a farm?
We have several lines of business. The first lines of business is to sell a production unit that is an out-of-soil cultivation and gives the chance to the farmers to work in a standing position. So the efficiency of the production is very high with low people that work very well. And the production is a farming on demand. Is a farming on demand. So
here's what's happening to your pitch. We're already several minutes into the pitch, and I don't think you've grabbed us with. We're still struggling to understand what is the business, and that's not a good place to be in. People tune out. If you take that long to get to the point, people tune out. So what are you selling and to whom is really important to get to very quickly.
Okay, we do sell, we have two lines of business. The first one is a franchising proposal to farmers or to investors that want to enter the agricultural market. And we are in a pre-seed to launch the farming on demand solution for virtual farmer, where final customer that can be that is a business to consumer offer and an offer business to business for hotel, restaurant, and catering. They can decide the seed to fork solution. They can decide which kind of plants they want to be cultivated for them. So we exit from the euro kilo or money for weight, and we give them a solution that is a cultivation plan, a service of cultivation.
So, Davide, here's another point that I want to make. It's hard enough to do one business as an early stage entrepreneur. Two is impossible. So if you were to pick one of the two businesses, which one do you think is more promising?
In order to give to the market a product that today is not there, we need to have the production in franchisee. So if Coca-Cola do sell their own products, and they do a production franchisee, we are selling a production franchisee. Our customer, I'm a result driver and a customer-oriented business I run. Customers ask us a selling solution. So we have been obliged, and we want to create a franchising network that sells directly in a short chain to customers. And this is a service we give to the franchising.
Okay, so but you have not started this franchising business yet, correct?
In Italy, we did the first press campaign in 2018 to recruit the franchising, and we have been through bureaucracy. We had the first building site in March 2020, the second building site permit from government in October 2020. So today we have two open building sites, and 85% it's done. So in the next 3-4 weeks, we are going to close the building site, start running the ecosystem, and we already have a TV contracts to do the launch, the marketing launch in TV.
So my take, and I'm going to turn it over to Ben in a moment to give you his take. My take is you are probably going down a lot of dead ends, running into lots of bureaucracy and so on. Right now, especially in the COVID era, we are seeing a lot of very interesting e-commerce businesses that are coming up and going directly to the consumers, or going, including farms that are directly to the consumers. Just yesterday, we ordered from an internet company called eFish. We got like a couple of pounds of escargot, and it came straight from the farm. And these entrepreneurs are able to reach customers. So instead of, I think you should consider, I think you're thinking of business in a very non-information technology way. And if you think about, if you put on the hat of what information technology can do to your thinking and what e-commerce can do to your thinking, I think you would start moving much quicker and start generating revenue much quicker instead of kind of spinning into bureaucracy and franchise and blah, blah, blah. Then I'll turn it over to you to give Davide your feedback.
Sure. No, I think some of your early comments were spot on. You know, Davide, when you're pitching, the biggest challenge is you always have a finite amount of time and a finite amount of real estate on the screen. The way WebEx is sort of, I don't spend much time on WebEx, I'm usually on Zoom, but because of the format, your slides are extremely small. So I kept trying to, I'm trying to look at things. The two things I pulled out of this are, one, it seems like what you are doing, if I was going to give you back an elevator pitch, is farming as a service. You had a slide that said that, and that sort of stuck with me as what you're probably doing. Although I'd say, similar to the earlier comments, I'm not entirely sure what you're doing. It was very general and vague, and you talked about the bureaucracy, and I'm like, I don't know why I care. And also there was, I think that because you sort of, it sounded like you allow elevated farming where people can stand up, they don't have to bend over and hurt their backs, that an image would be a very good way for us to understand what you're doing, being able to show us the actual product. But the most specific advice I'm going to give you is, well, first, two things. One, specifics are your friend, generalities are your enemy. Nobody learns anything from generalities. Be careful with how long of a preamble you have, because it may or may not be relevant. Okay, so there's some images that help me. Okay, so it's a vertical farming structure. Okay, well, now I know you're into vertical farming and you're doing farming as a service. Great. That tells me more than anything I heard, to be honest. I mean, there's a lot of vertical farming organizations that do indoor warehouse-based farming where they recycle the water and they do all kinds of things. But you didn't get to that particularly. I think the point was made earlier. You need to get to it pretty quickly. I run a site called pitch-ben.com, where anybody in the world can pitch me a 1-minute video of their business, and I will give them a 1-minute video response. It's a way for me to increase deal flow and to sort of be available. People are always asking, how can I get to a Silicon Valley venture capitalist? I bring this up because I get a lot of pitches where my advice comes down to, you gave me a bunch of generalities, you didn't tell me specifically what you do, I can't give you any feedback because you weren't specific enough. And I often say, your job in a pitch is sort of the 5 W's. Who are you? What exactly are you doing? Who are you doing it for? What are they paying you for doing it? And how is it going, right? Traction. And so I think when you start there, you can always go into more broad strokes later. You got to come in with that. I'm Ben Narasin. I spent 45 years developing a new polymer. And now I am starting a company that sells new polymers for wrapping produce that reduces rot. And this will increase the life cycle of that fruit from 4 weeks on average to 6 weeks. My customers are farmers. They pay me $4 a ton, and I'm doing $1.2 million in revenue right now, and I will be doing $3 million by the end of the year. Boom. Okay, there's who I was, what I was doing, who I was doing it for, how it was going, what they were paying me. Okay? So I just made all that up, obviously, but that sort of concise 5 W's thinking is usually effective for any sort of pitching, including a 1-minute pitch, because the best pitches are concise and get those points across. And it is important. I'm not diluting the importance of the story. In fact, storytelling is one of the most important characteristics an entrepreneur needs to have the ability to do well, because storytelling is how you raise money, it's how you hire people, it's how you land customers, it's how you promote your product and your vision and your offering. But I think a lot of these visuals, although I don't know if maybe I'm not using WebEx right, but there's just this is a form issue. Like I don't know how to get your screen to fill up my screen, and so I can't see the detail. So one last point for you and for everybody else, I try to make my feedback useful to others as well, is that generally speaking, when you're building a slide deck, less is more. It is not your job to stop when there's nothing left to add. It's your job to stop when there's nothing left to remove. Each slide should be very concise, specific, and have 1 point on it and 1 point alone. And you should look at every single element of that slide and say, what can I remove from this? Does it earn its place? So I'm looking at the slide right now with an eggplant and some I mean, there's a lot going on that slide.
Doesn't say anything. The slide doesn't. Most of these
Right.
slides are not saying anything. I think that's a problem. So, you know, Davide, I think there is an existential issue in your business. Is who are you? What is the business? I don't think you have clarity on that, and therefore you cannot communicate something clearly to anybody. So what is the business? First, answer that question. Are you selling farming equipment or a particular farming technology, or are you selling farm produce? Even that is not clear in this pitch. So I'm going to stop there and move to Charvi. But my general sense of this is that this is it's very, very hard to understand in the time that we have here. Maureen, I seem to have, Davide, you have taken control of the screen. Can you release control? Just a second, Charvi, I'll give you. Here we go. Charvi, you're up next. We can come back to more Q&A, Davide, after Charvi's pitch and a little bit more. But for now, let's give Charvi an opportunity to share her story. Go on.
Hi everyone, I'm Charvi. I'm founder at PontApp and a full-time employee working as financial analyst in US-based mortgage company. And I'm working in India, so as it is US-based, so I'm working in night shift. And because I'm working in night shift, that's why I'm having plenty of time to put for my startup. So without wasting much time, I would like to introduce you all with my startup. So I have launched an application, mobile application named as PontApp. So through this application, we are digitalizing the appointment system. How we are doing it, we are targeting various industries. Various industries, I mean, like we are targeting hospitals, salons, luxurious and premium apparel stores, jewelry stores, so that people can take online appointment before going out of their homes. So how this idea came to my mind, last year itself when the COVID situation was happening in our country, in all our country. So I find this thing that there should be appointment system. No one should go out before, like unnecessarily. They should take appointment so that for the concern of the safety for vendors and for ourselves also. Next slide, please. Yeah, so these are some of the reviews which I have put from the Google, which I have taken out Google, that people are not happy because of the so much of crowd in the store. So these are just general reviews. I got it. Next slide, please. So yeah, the problem is like there are so much crowd at once at the store. So, appointment system is not a new concept, but the general idea is with appointment shopping, merchants have much better control over how many people should be there at once in the store. And after they are done with their shopping, what they have touched and what needs to be clean to ensure safety for all and everyone. So this is the first problem, that so much crowd at the store. Next slide, please. Next is rush hour rules. So basically, if there is so much crowd at the store, so sales associate need to attend everyone, and because of that, they are missing on the white glove experience. They are not providing one-on-one experience or personalized experience, because of which they are missing on customer loyalty as well. The customers are not going to come back if they are not treated the way they want to get it. Next slide, please. So they are the same thing. It is saying that they are suffering from the customer loyalty. They are not getting personal experience. That's why most probably there are chances that customer is not going to come back to the store because of the experience they had earlier. Next slide, please. So they can give attention to everyone, each and every customer, how through PontApp. PontApp, they can take appointment. If I'm taking appointment, vendors know well in advance, like who is going to come at the store or hospital or salon, and they can give one-on-one session, one-on-one personalized experience, which will help them to create brand loyalty, customer retention, and most important, safety and security. So next slide, please. So yeah, so we have a system, proper system, just like Zomato is having. They are having one application. The same way we are having mobile application through which anyone can take appointment. They just download the application from Play Store and they can easily book the appointment. And the moment the appointment is booked, it will trigger a notification to vendor. We have provided a web application. Just like Zomato is having a web application, we have created our own web application on which they are going to notification is going to come that appointment has been taken by so and so person at so and so time. So now
so Charvi, stop for a moment.
Yeah.
Who are you selling to? Who is your customer? Is it the store that is your customer? Is it the consumer that is your customer?
So basically, we are working as intermediary. Consumers, we people are also a customer of my application, and vendors. From where I'm generating revenue from both the ways. How? If I'm taking appointment for any salon or apparel store, I need not to pay anything. If I have taken appointment and I am visiting the store, then the vendor of the store has to pay me some amount because I have provided them a system through which appointment has been taken. So they have to provide me some amount, which is like specifically we have done a contract. But for the hospital, if I'm taking an appointment for any doctor, so I have to prepay it. I have to give the consultancy fee in advance, and I'm going to charge. Right now, I am charging 7% per appointment from consumer and 7% from doctor also. So that's how I am generating the revenue.
Okay, so
I hope
there are several issues. There are several issues that you need to think about. First and foremost, you started this conversation by saying every segment is applicable to your business, whether it's hospitals to stores to blah and blah and blah. I think that's the wrong way to think about it because every single segment has a very different dynamic and very different usage model. You know, the workflow of each industry is different. A hospital operates very differently. You know, a private doctor's office operates differently, a retail store operates differently, a mall operates differently. And by saying that you are going to, you know, have stores take appointments, it completely changes their entire workflow. And people don't change behavior like that easily. That means that if you say that, oh, I'm going to help you create an appointment to a consumer at a store, and the store is going to be empty at the time, it's going to be, you have a white glove experience, well, then on the store side, you need commitment that the store is going to be empty at the time and not going to be full. How does the store manage that? It's not manageable. So you are proposing something that I think is not necessarily achievable in any reasonable way. Unless you get buy-in from the store or from whatever your B2B customer is, to make that kind of change and offer that to their customers. So if you are a kind of like a super app that wants to cater to all consumers and all businesses, I don't think that necessarily works unless you can get the buy-in from the businesses to organize themselves to offer this kind of service. Now, COVID, of course, is a factor that has created a need for, you know, social distancing. So people are more interested in facilitating a socially distanced experience, but I would validate who is willing to do that with you and which segments are willing to do that with you. Hospital, if you were trying to go and sell to hospitals and manage a hospital experience, that is an enterprise software business almost. And that's a very different business from being a super app where you're kind of like a marketplace for appointments and so on. So again, there is an existential issue on what is your business. Ben, I'll let you weigh in.
Yeah.
Hang on.
Well, let me start by saying, you know, I think that, well, I agree with a lot of what was just said, and I'll tell you some other thoughts. I do think you did a good job on the deck. I thought you did a good job presenting. You know, you basically hit the who, the what, you know, you spelled it out pretty clearly. I think there's probably a little more specificity. Actually, because you're app-based, I generally tend to encourage my founders to do a demo really quickly. You know, you said who you were, you said what you were doing. That would have been the perfect chance to say, let me show you an example. Here's Bob. Bob wants to, you know, get an appointment to buy groceries, followed by an appointment to pick up some stuff at the pharmacy, whatever. The main thought I had along the way, though, is it's a pretty crowded space when you're talking about organizations that need people to make an appointment. As an example, like you talked about salons, you talked about like whether there's the people that are doing all this for yoga studios, or I remember Mike Maples funded a company that was doing this for dental offices, where they went with a one vertical approach. Now, interestingly, if I remember correctly, the company that was doing this for dental offices did okay with the appointment making, but it was never going to be a big business. But then they expanded the offering within the dental offices, and they were able to make a successful run at it. But I know there are a lot of, the problem is if you're a generalist offering, I would agree with the point that getting people to change behavior on either side is always extremely difficult. And while probably during COVID, you would have been spot on, because, if it is there like it is here, stores were open, but they would limit the store to 6 people at a time. And so your app would have worked a lot. But effectively, everybody's back out now, at least around here. And, it's funny how quickly, I've said this ever since COVID began, everything reverts to where it was before. Like, everybody's shaking hands again now. I keep trying to fist bump and they're like out there with their hand. And I was like, come on, man. That's, I thought we learned. But it is amazing. People's capacity to forget is huge. And I think that, people's behaviors will go back to what their behaviors were before. And so I think that creates a challenge for you. But I do think finding a vertical to focus on, because there's so many people doing this for so many different verticals, what might be an option is to find a vertical that is not yet served, that already works on appointments, and digitizing that system for them, and then seeing ways to expand within that vertical so you get more penetration and more value in one vertical by offering them multiple things versus trying to be all things to all people appointment wise, which I can see in a parallel world that doesn't exist right now how this could be beneficial to everybody. It's just that, to the point that was made earlier, you have to change their behavior. You are betting on the hardest thing to bet on, which is to get people just to change the way they live their lives, and the merchants as well, because all of a sudden, instead of just waiting for people to come in, I've got to be queued up. Now, the one idea I did have, I'll make this the last point, is I wonder if there's a super concierge level of service you could provide, where since you're allowing people to make appointments, you actually go all the way to the other extreme and focus on sort of an ultra affluent, or let's call it aspiringly affluent person, where maybe it's not just the appointment, it's maybe there's an aided journey once you get there, where, like if you think of high-end department stores as an example, particularly in Europe, they have personal shoppers, right? So you go in, you have an appointment with a personal shopper, and they take you around and show you the things they think. Actually, they bring the things to you. I took my daughter for her birthday to Paris, and we went to one of the fancy stores, and she didn't get to buy anything. Unfortunately for her, she thought she could. I was like, oh, no. But the personal shopper brought her all the things and showed her all the stuff. So perhaps there's a model like that where you disconnect yourself from the store. All of a sudden, you make the appointment with a personal shopper that meets you at the store. Now, in fairness, I'm saying something that if you were pitching it to me, I would say, wow, there's a lot of friction in that. There's a lot of moving parts. But maybe you can TaskRabbit style marketplace it off on the other end. I have seen businesses where people wanted to sort of empower, like let's say I think I'm just a highly stylish man and I could help other men shop better. And, I'm not working a lot right now. Maybe I would be the person that would be more than happy to make that appointment to take you through the store. Or I'm a foodie and I could, we had a friend, enough. But I think you did a good job on the pitch. I think the deck is pretty well architected. But you've got to, it's tough to be in a competitive.
Charvi, do some competitive research. There is, we have seen actually this kind of businesses come through quite a lot. We've done some case studies as well. If you go check on the website, there are lots of free case studies as well of this appointment setting kind of businesses in different verticals. So this exists. There are various different businesses that are catering to different verticals. You are in India, do it specific to India, who's doing what in India, and then see where the gap is, and if that gap appeals to you. And then you will learn how to do this business. This business, actually, we know how to build these businesses. You don't need to do it as a super app, but you do need to find the gap because there are lots of those out there. The reason we know how to do these businesses is because a lot of people have done it. So I think you need to frame your business differently, and that is going to require a lot more competitive analysis. And then if you decide that you want to frame this completely differently, as Ben is pointing you to these other concepts and constructs like the personal shopper at stores, or, heritage walks. I see, when we travel, often we hire guides to give us heritage walks, or, food walks, these kinds of things. That's an appointment business. So there are ways to apply your appointment concepts, but you have to apply it to something that's where you can actually build a business.
I want to add a small point over here. May I?
Yeah, of course.
Yeah. Thank you so much. Thank you so much for your great feedback. But I wanted to say one thing, like the idea behind this, I wanted to give only single platform for all the industries so that I need not to have so many apps, or I need not to go to different websites or to call them, Google their number and to call them to make appointments. So that's why this idea came, that, to have all the industries on single app, just like Urban Clap is having it, all the industries on a single application. Apart from that, store, I don't mean store like Zara stores or H&M stores. I am here saying, like, in India, as I am in India. So in India, we are talking about the designers, where, as you are saying, personal shoppers, that's what I am doing over here. I am listing only the designer stores where, one person needs to be attended. So
then focus on that. Focus on personal shoppers at designer stores, and just, see if there is a competitor or competitors in that space, and go into that. The attempt to become like the super app for all industries is a very expensive proposition, and it's not clear that that's going to necessarily work. So you have to kind of figure out a manageable piece that you can start with and start, being viable with. So if designer personal shopper is your thing, that actually works. For me, that works.
Yeah. Okay.
Okay. Very good. All right, folks, I'm going to spend a few minutes explaining to you how to use 1 million by 1 million. If you like what we do, as you can see, we're not really sugarcoating feedback, right? We're giving you feedback, raw feedback, and candid feedback with which you can hopefully do something, actionable feedback. So if you like this approach, send entrepreneurs along, and we will be happy to work with them. Everything is at 1Mby1M.com. There's a blog that has been going on since 2006, one of the earliest technology blogs. When I started doing entrepreneur journeys case studies on my blog, people said, oh, it's too long and so forth. But Entrepreneur Journeys as a blog series has found its readership. And today I find lots of entrepreneurs come and pitch me who have done most of their learning by following the Entrepreneur Journeys blog series. We've done thousands of these case studies. So definitely check that out. The Entrepreneur Journeys book series is a distillation of the blogs and turning them into 12 to 16 case study books on various topics. And that includes stuff like bootstrapping with a paycheck, bootstrapping using services, some of the constructs that we have discovered in doing these case studies of how entrepreneurs have managed to get companies off the ground. These roundtables are happening every week. This is, over 500 roundtables at this point. Over 150,000 people have pitched. It is a democratization of entrepreneurship, education, incubation, and acceleration efforts. So we don't screen as long as you're working within our space. Our space, by the way, is IT and IT-enabled services. So Davide's pitch was a little bit, because it was unclear what it was, it's a little bit outside probably, unless he's using information technology in a significant way. It is probably outside of our scope, but Charvi certainly is within the scope of what we do. We do IT and IT-enabled services only. So if you're doing healthcare IT or digital health, that's fine. If you're doing life sciences, that's not what we do. The premium program is where we do the full acceleration work that offers you extensive methodology guidance, a full digital curriculum. We help you with business development through our Rolodex. You get similar roundtable strategy consulting sessions where you can discuss your project week after week after week. It's usually an annual membership fee-based program. You can join the program and spend a year, but there is no sense of graduation really. You can continue to, we've had entrepreneurs use the program for 3 years. So there is no, we're not going to boot you out of the program. You can continue using it as much as you want. You can continue using the network, the mentoring, etc. Our financing help is through our network of investors. We have a very large network of investors who work with us, and we stress heavily that notion of investor-entrepreneur fit when you're looking for money. So until we consider you fundable, we're not going to send you to investors. And when we send you to investors, we'll send you to a set of investors who are likely to pay attention to your venture. We have a lot of clout in the media, so we can get the word out about you. Go look at the self-assessment on the website. That's a set of questions that investors are going to want to try to understand about your venture and try to answer those questions. There is a free bootstrapping course. It's about an hour course that LinkedIn had commissioned that we put together, and it's been very, very popular. Hundreds of thousands of people are doing this course, so you're very welcome to take a look at it. We also have recently started releasing Udemy courses based on the 1M1M methodology, and there are 25 of those on Udemy. Check those out too. And if you want to access just our curriculum and start plugging your knowledge gaps, especially if you're doing the self-assessment and you find that you are hitting knowledge gaps, you can go look at 1M1M Basic, which is our full curriculum at $99 a month. You can take a look at that. So on the website, everything is described in detail. You can take a look at what to expect from premium, what to expect from basic, all the FAQs, video FAQs, the full curriculum description, etc. It is a case study-based program. We have thousands of successful entrepreneur case studies. The investor introduction policy is outlined very clearly on the website. Our methodology is bootstrap first, raise money later. There is a Udemy course on bootstrap first, raise money later as well. That's it. The next few roundtables are July 22nd and 29th, and then August 12th, 19th, 26th. That's it. If you have questions, please feel free to ask more questions. Charvi, Davide, you're welcome to ask more questions if you would like to. And if anybody else in the room would like to ask questions, please feel free to dial in or type in your questions in the public chat, and we'll be happy to answer. If you have questions about the 1M1M program, Irina Patterson is your contact. Anybody? Questions? All right. I don't see any hands up, so we're going to wrap up and get going. We'll see you next week. Thank you for coming. Bye.